Hello, friends. There are concerns in the market about the return of COVID, and some section of the market feels that COVID based lockdowns that were imposed in March 2020 and which resulted in the market nosediving might just be repeated. In this video, I want to address that topic and look at statistical data and tell us where the markets are going and what may be expected. Last week in my video, I told you that risk appetite remained intact. And guess what? That risk appetite turned out to be the undoing of the market because all that greed, all that buying has now turned into panic-based selling. Coming up on your screen right now is a market roundup window, which tells me that banking led the way down. Why? Because if you've been following me on my Telegram channel, it's a free channel, not behind a paywall or any subscription required. I have been warning my online family that interest rate sensitive sectors are likely to see some amount of downward pressure because cost of funds is rising. The sagacious, the savvy, the discerning investors and traders know that when cost of funds rise, and it comes with experience, of course, that markets, equity markets, asset markets, riskier asset markets in particular, tend to fall. So, which is why banking fell because it is more interest rate sensitive than the other sectors. The broader based Nifty also fell, and the US dollar index eased, which you can see it's fallen by 51 basis points, and that resulted in bullion rising. Crude oil rose because there were supply disruptions expected, and natural gas collapsed. Do remember, I've been telling you in my last few videos that natural gas, when it was going up, I told you it is going up purely because of cyclical reasons, and come summer, natural gas prices are likely to be lower than where they are right now. The USD INR gained 9 basis points. That means the rupee eased against the dollar, which is another reason why there was pressure on the downside. The 10-year benchmark bond yields rose. That means bond prices fell. That created mark-to-market pressure on banking because banks are the biggest holders of bonds. And what you're seeing is the NSE market cap fell a whopping 4.68%. Now, empirical data that we track in our company in-house tells us that 4% or higher decline in MWPL for 3 to 4 consecutive weeks leads to a bear market. Now, this is the first week we've seen a humongous fall like this, and this is definitely a red flag. MWPL fell, which is slightly premature because normally it peaks out on Monday to Tuesday in the expiry week. But in this case, it has peaked out a little earlier. The US markets were a mixed bag because the headline Dow Jones index rose a little, but broader based indices fell. On your screen right now is the Dow Jones Industrial Averages daily chart, where the death cross has been negated into a golden cross, where the 50-day average is above the 200-day average. But the price is not really showing any signs of significant life. Although the price has risen on 3 trading sessions out of 5, the falls were deep enough to restrict the rise. Now, what I would want is a sustained closing above the 33,272 and preferably a breakout above the 34,281 to say that the Dow Jones is going to go again into a bullish phase. Let's take a look at the NASDAQ 100 index. Now, this index is directly responsible for the outlook on our technology stocks. It managed to basically rise on Wednesday and Friday, but net, it still remains under pressure. Death cross remains in place, and the 11,682 level, which I want the index to stay above, is still way out of reach. So tech stocks are still under pressure. The broadest index of them all, the S&P 500, still remains below the 3,905 levels. Now this index again did rise on 3 out of 5 trading sessions, but net it's still underwater. So the US markets on the whole aren't really going great guns, and that's not really good for the market. Coming to the MWPL chart, what we are seeing is the MWPL has eased on a week on week basis, which is a little premature. Like I told you, risk appetite has gone down a little. And if you remember your basics of accounting, where we used to be taught about inventory and stock valuation based on LIFO or FIFO method. Now, LIFO is more important here. LIFO is last in, first out. Where traders are concerned, when we initiate an open position, when we enter into a trade, and that starts to lose money, you tend to basically knock out those trades which you have entered recently. You're emotionally attached to the older trade, so you don't touch them in a hurry. What we saw was LIFO based selling in the week gone by. So that is red flag number 2. Right now, what you're seeing is the index and stock futures turnover. It's a 3 cumulative expiries of December, Jan, and Feb, and turnover has gone up. That means one marshmallow traders have participated in the selling, which means that the pressure was with higher volumes. Another mild red flag. Let's take a look at the advanced decline ratio vis-a-vis the Nifty percentage gain or loss. Now, last week, the Nifty has lost 2.53%. The loss is bigger than the week prior. But take a look at the advanced decline ratio. This is an average of 5 trading sessions of the week. Now, even the weekly average has almost gone to 0.5. So, for every 100 losers, there were only 56 gainers. Now, this advanced decline ratio, my friends, is after the price the most leading indicator of which way the markets are going. And for the week gone by, bulls were exhibiting even lower buying conviction levels, even on an intraday basis. Now, that is another concern. Take a look at the basis. Basis is nothing but the premium or discount enjoyed by the futures over spot. The basis for the Bank Nifty has gone up a tad, 10 basis points, whereas the Nifty 50 basis has eased. The reason why basis hasn't really come down sharply is because of short covering at lower levels, which has been cushioning the declines. Now, this is one aspect that I have been pointing out on my social media accounts, where I post all these updates on a daily basis at the end of the day, late in the evening. Now comes the impetus chart. This is our exclusive in-house indicator you won't find on the internet. Last week, I cautioned you that the markets had fallen on a rising impetus, and sure enough, the momentum or the impetus only went higher. Now that the declines have deepened and the impetus has also jumped to the median range of the 20-week look back period of this chart, I feel that the selling has gathered more momentum. It could lead to a crowded exit. Will it repeat the March 2020? I will come to that in a bit later on in the video. Now let's take a look at the LWTD indicator, which is again an exclusive in-house indicator that we've developed. It won't be available anywhere on the internet. You've learned to trust it for over 3 quarters now. And the red color line is the LWTD. It has sunk lower below zero for the 3rd consecutive week, which is telling us that buying support on declines is getting weaker and weaker. Now, this is again something that I update on my social media accounts on a daily basis. This is a weekly chart. But if you connect with me on social media, particularly our Telegram channel, where the backbone of our research is put up for free, you will get yourself to update these indicators on a daily basis. Now, for the footprint of the 4 market participant types, I start with the FIIs who've basically covered their short positions in individual stock futures and gone net long, but their index futures positions are now into a net short situation. So they're basically taking a hedged approach. Where DIIs are concerned, they've increased their short positions on individual stocks and reduced their short positions on the indices. And DIIs, remember, do tend to remain net short because they buy in the spot segment to support the market and they hedge their positions by shorting in the futures. Where prop traders are concerned, these guys have gone even more short on the indices, but they've gone long on individual stock futures because these prop traders are brokers, own trades, and they happen to know who's buying, who's selling, and how much. So they're second best to insiders, and they are focusing on a few counters where they feel that there is juice in the price left. Let's take a look at the retail guys who've done most of the heavy lifting after the lockdowns were imposed 2 years ago, and they've reduced their individual stock futures net long positions. Part of this could be due to the impeding expiry of the December futures series and the holidays, and their index net long positions have gone up. So reduce stock longs, go long in the index. Here again, it's the hedged approach. Friends, I now come to the 4 index heavyweight stocks and their outlook. It's a very critical study because these stocks, due to the very heavy weightage in the indices, impact the indices with their own stock prices. I start with the biggest boy of them all, Reliance Industries. Look at the falls of Wednesday, Thursday, and Friday. Big power candles, bearish power candles. The bearish candle of Friday is the longest in some months. It smashed below the 2,542 level, which it should not have. Now, for Reliance to actually start supporting the index, it will have to go up above the 2,618 levels. That's a long shot. Unless that happens, I'm a little cagey about buying Reliance. And look at the 20-day moving average, which is a month-long holding on cost of an average bull. It started turning lower. So with a weightage of 11.36%, Reliance is not supporting the Nifty at all. Now for HDFC Bank, the second heaviest weighted stock in the Nifty and the heaviest weighted stock in the Bank Nifty. It fell with the gap down on Friday. As a matter of fact, again, it's fallen for 4 consecutive days last week. The price is below its 20-day moving average, which again is a proxy for a month-long holding on cost of an average bull. So a short-term buyer is underwater in HDFC Bank. But compared to Reliance, it's a slightly better chart. Infosys, do remember the Nasdaq 100 index in the US market segment that we talked about is still underwater, which is why Infosys is unable to go past the 1,555 level, which coincides with a 25-day exponential moving average, which is a month-long holding on cost of an average bull. So Infi is also under pressure. ICICI Bank so far was the strongest chart of the 4 stocks that we talked about. It's the second most weighted stock in the Bank Nifty and the 4th heaviest weighted in the Nifty 50. The 20-day moving average has started turning lower, my friends. So the last bastion of the 4 index heavyweights has also crumbled a bit. And what we need to watch is whether the 867 levels is holding. If it is not, then you're looking at 836 to 840 area, which is not really good news. Friends, I now come to the bond market. Those of you who've been following me long enough, my online social media family, know that I take a 360-degree worldview of financial markets, and I'm a big votary of fixed income, especially sovereign investments. On my Telegram channel, time and again, I have been warning you that cost of funds is going up, and that is something that the bulls will have to pay a price for. This is definitely a lagging indicator, but over a period of 2 or 3 quarters, it definitely has an impact on riskier assets like equities, and it pulls prices lower. It is inescapable. You can't run away from it. And look at the bond yields. It's risen. The Indian 10-year benchmark bond yield has risen a tad, which means bond prices have fallen. Are we expecting higher inflation? Yes, probably. Are we expecting interest rates to continue? Yes, probably, if the bond markets are any indicator at all. So the crux of the question, crux of the discussion on bonds is, should you continue to ladder? I would say yes, in all sagacious, savvy, discerning, yield sensitive manner, yes. Why? Because when riskier asset yields are falling, when your return on investment on riskier assets is falling, you need something to put food on the table for you. And that's when bond interest comes to the rescue. Now, bonds are for the wealthy investor. There's a difference between being rich and moneyed and being wealthy. There's a big difference. When you are wealthy, you want to protect your wealth. Therefore, you want to allocate some assets in the bond market. So, should you continue to allocate? Yes, please do. And would I allocate immediately? Not really, because I do expect yields to go up a little. I would stagger out my check. My next check would be when the bond yield actually approaches 7.50. You can remain assured there will be an update on our Telegram channel, and the channel is free for you to join. Friends, I now come to the US dollar index, which has basically fallen on a week-on-week basis. As you can see on the daily chart on your screen, it remains below its 25-day exponential moving average, which is a month-long holding on cost, and it fell on 3 out of 5 trading sessions. And the moving average itself is headed lower. Ideally, the US dollar index should have been above 104.51 to support the bulls, but it's not. The longer it stays below 104.51, the higher is the probability of touching 102.75 or 103. And a falling dollar index is actually positive for emerging markets, including India. This has basically taken away some of the sting of the selling. Now, take a look at the weekly chart on your screen. The price is below its 25-week exponential moving average, which is a 6-month holding on cost of a bull. So medium-term outlook is bad. It's negative. What's more important is that for the last 5 consecutive weeks, the weekly closing of the US dollar index has been in the lower end of the week's range. That has to end. Even though net the dollar index closes negative for the week, at least the closing has to be above its opening before the bulls see some relief coming in. Till then, I think the dollar index is supportive for India, a falling dollar index, I mean. Now, last week, I advocated a range between 107.24 on the upside and 102.44 on the downside, which held perfectly well. In the coming week, I expect a range between 106.64 on the upside and 102.02 on the downside. Friends, the dollar index done, I now come to the bank Nifty, which took the brunt of the selling. It fell 3.59% on a week-on-week basis, and the daily chart on your screen tells you that it fell on 4 out of 5 trading sessions. And starting Tuesday was a muted fall, but Wednesday actually threw the bulls out of gear. The price closed below its 25-day exponential moving average, which is a month-long holding on cost of a bull. The average itself has turned lower from Thursday onwards, and Friday was a slam dunk day, which opened with a gap down. Now, the 41,840 level was a previous swing high. If we are managing to stay below this level, then the bulls are likely to be even more under pressure, and support on the decline is way below. Now, do remember, at the risk of being repetitive, I've been warning you that banking is vulnerable to rising cost of funds, and so are all other interest rate sensitive, including NBFCs, which are quasi-banks, non-banking financial companies. I've been specifically telling you those sectors that are interest rate dependent for sales, companies that need EMI-based sales to boost their top line, will come under pressure. And there you have it. It's come quicker than I thought. I was expecting it to happen after a quarter or two, but there you're seeing it happen in a Santa Claus rally in the middle of a Santa Claus rally itself. Now let's take a look at the weekly chart on your screen. The week prior saw an inverted hammer. It was like a pin bar. And last week we followed with a power candle, a bearish power candle. It's the biggest in many, many months. Now, I talked to you about mean reversion in many of my videos in the last few weeks. Mean reversion is when the price comes towards its moving average. Either the price falls towards the average or the price goes sideways and the moving average tries to catch up with the price. Now, this is a classic mean reversion in progress. If the price touches the 25-week exponential moving average, which is a 6-month long holding on cost of an average bull, and bounces back, all is okay. It's a deep but required correction. If it falls below it and stays below it, then the bulls are in some serious trouble. Friends, last week, in our in-house list that we maintain of statistical beta, top beta securities, which are the most volatile, this index was number 5 in the week before, number 4, in the week before last, but it fell one notch to number 5. Now, before you start celebrating, here's the thing. It's not that the statistical beta of Bank Nifty that has come down. It's the statistical beta of individual stocks that has risen faster than the Bank Nifty, which is why you're feeling that the statistical beta ranking has gone down. It's no cause for celebration at all. The market itself has got a whole lot more volatile. Now, last week I advocated a range between 44,525 on the upside and 41,925 on the downside, which was breached because the week's low was 41,597, a good 328 points below what I expected the support to be at. In the coming week, I expect a range between 43,025 on the upside and 40,300 on the downside. The range might appear expanded to you, but do remember the high base effect, the big bearish power candle itself is going to come into play, and statistically the base effect will result in a bigger range being projected for the future. My advice, which I repeated, which I will repeat since the last few trading weeks in my videos, stay light, trade light, hold your trades with a stop loss. And like I said in a special segment last week of what I would do in the week ahead, I told you very clearly, I would want to square up my positions on the day itself. I would not roll over my positions in any direction. Why? Because the statistical beta is too wide. The spreads between the bid and offer are too wide, and that's making me really uncomfortable. Friends, the Bank Nifty done. I now come to the Nifty 50, which fell by 2.53%. It fell on 4 out of 5 trading sessions, as you can see on the daily chart on your screen. The price is below its 25-day exponential moving average, which is a month-long holding on cost of an average bull. The average itself has turned lower, which is not exactly very good news for the bulls. And we've broken below quite a few previous swing highs of 18,351, 18,115, and therefore the bold red downward sloping trend line, which connects all the peaks that were made after October 2021, is now likely to offer support at 17,450 odd levels. I'm not saying that that level is coming, but that is where the support is. Going to the weekly chart on your screen, here again, number 1, remember mean reversion. The price has to come towards this moving average, or the moving average has to come up towards the price. In this case, the price fell. Here again, like the Bank Nifty, last week we saw an inverted hammer, which is like a pinball. And that exerted downward pressure. And here again, you have a bearish power candle, a big candle. So whether the price bounces from its 25-week exponential moving average, which is a 6-month holding on cost of an average bull, which is at 17,700, or it falls below, that will determine how much deeper the Nifty has to go. Now, Last week in our statistical beta rankings, the Nifty was at number 10. This week it has fallen to number 11. Here again, it's no cause for celebration. It's just that individual stock volatility has jumped through the roof. Last week, I advocated a range between 18,750 on the upside and 17,775 on the downside. And I'm very happy to tell you that this low held. What was the low? 17,779 actually, just 4 points above the support. Now, this is the kind of work that we do in IBEX, our in-house statistical trading model. And it's getting better and better with time. The coming week is likely to witness a range between 18,300 on the upside and 17,300 on the downside. Here again, it's the high base effect which is resulting in a wider than usual weekly range. Friends, the Nifty done. I now come to the last bit of statistical analysis of the retail risk appetite by way of the contribution of volumes generated by the retail. If they are trading higher in stocks, the risk appetite is high. If they're trading higher in indices, risk appetite is low. Even amongst the stocks, if they're trading futures more than options, the risk appetite is extremely high. So on your screen right now is the purple line, which is the percentage gain or loss by the Nifty itself. Nifty has obviously fallen. The sky blue line is the stock options turnover. What you can see is that the stock options turnover has gone through the roof. It's the highest in the 20-day period that this chart covers. The olive green line is the stock futures turnover. That is also at its period high, which means that the retail guys have shown higher risk appetite and they've gone short in individual stocks. Now, the index futures are shown by a red line. They are also high. They've risen on a week-on-week basis, but pale in comparison to the stock futures. So, retail traders have gone on the front foot and have shorted the market. Now, the next chart is the turnover contributed by the index options. This segment of the market contributes more than 95% of the turnover in the entire F&O space. The reason being, the NSE computes this as a capitalization or notional value of the contract traded. What we are seeing is that the index options turnover is the lowest in many, many months. The chart, of course, covers only 20 days, but our back office tells us that it's a multi-month low, which tells you that traders have not been hiding behind the indices. They've come on the front foot and shorted individual stocks. Friends, will the markets fall like March 2020? I promised you I would discuss that. Now, first and foremost, do remember that markets have a memory of their own. Just like you go to a gymnasium, you work out and you take a break for some days. You go back to the gym and start pumping iron again, your muscles don't get sore like they did in the first time. Why? It's called muscle memory. Prices also have a memory. Markets don't witness 100% repeat of a previous situation, but they do definitely rhyme a little. They may not be an exact carbon copy, but they rhyme a little. So the COVID news, when it came, has definitely set the cat amongst the proverbial pigeons. But are we going to see a waterfall-like decline? I think it is too premature to say so. On one hand, I would not rule it out because being in the market for 36 years has told me, hey, anything can happen in the markets. But to make a blanket knee-jerk forecast that everything is doomed and going to fall, just like gravity has suddenly come back in force, would be a little premature. Sure enough, there could be declines, but do remember that we have a budget coming up in February, and traditionally speaking, prior to the budget, there is some uptick. So at some point in time, the markets will try to attempt to find its feet. The other aspect about whether the market will collapse like 2020 is the fact that a whole lot of newbie traders have entered the market in the last 2.5, 3 years. And these guys have not really seen a bear market. They don't know what market declines are like. And believe me, market declines can be extremely, extremely vicious. This is the first time in 2 decades that central bankers are raising rates aggressively. So the bull market that so many of these newbies are talking about in the past, not having participated in those either, were fueled by easy money and cheap money. That era has come to an end. So wake up and smell the coffee. Like I said, there's a difference in being rich and being wealthy. The wealthy understand and respect the cost of money. They don't just respect money, they also respect the cost of money. The guys who only have money but no understanding of it don't give too much of a thought to cost of money, and the cost of money is going higher. Friends, I now come to the most popular segment of this video for statistically inclined traders, where I give you 5 stocks that gain the most amount of statistical beta on Friday. So you take small exposure, wait for large price moves, and 5 stocks that lost the most amount of statistical beta on Friday, where you take big exposure, wait for small price moves. These are for scalpers. Remember, this list is valid only for Monday. Tuesday through Friday, I update this list for free in our free Telegram channel. Do make it a point to subscribe to that channel as well. So the statistical beta gainers list is led by Shriram Transport Finance, Siemens, SRF, ACC and Adani Enterprises, which witnessed a big decline last week. The impetus losers list is led by HCL Tech, LTI, Intellect, Sun Pharma and Laurus Labs. Which way should you trade? Is it a buy or sell list? No, it's not just a plain buy or sell list. The direction will be determined by your snapquote window, the tutorial to which I have posted in my playlist many months ago. So this is just a list of traded securities that you might favor. Direction will be determined by the price, and price you will come to know in the open market. Friends, I hope that this video has added value to you, and before I wind up, I'll share what I would do in the coming week as a game plan. I would basically trade extremely light because Christmas would have come in and traded volumes would have shrunk significantly. Now, behaviorally speaking, and I basically am a big believer of behavioral technical analysis, I think wherever there has been a buildup of greed, which will show up in the highest MWPL gainers. I'm not talking of impetus gainers. I'm talking of MWPL gainers. That is where crowded exits might occur. I would target those stocks because there would be panic and pandemonium in those particular counters. So they are the soft, weak underbelly of the market. So I would target those high MWPL counters, and like I told you last week, I would start to bet on a theta decay on those counters without actually them going to the moon at all. So when traders are shifting from futures to options and options premium are going up, you can bet on theta decay. I would also avoid counters where the bid and offer spreads, the difference between the buy and sell price on your snapquote window, which you can bring up by clicking on F5, is wider than 6 ticks. Anything wider, I don't want it. Absolutely no way. This is my game plan. I would love to know in the comment section as to how it helps you become better traders. Friends, I thank you for being patient with me in this video. I hope you subscribe to my YouTube channel. Click on the bell icon to receive instant alerts about fresh videos being put up out here. And do share this video with smart traders like yourselves so that my work reaches a wider audience. I wish you a very Merry Christmas and a joyous festive season. Have a very profitable trading week ahead. This is Vijay Bhambwani signing off for now. Bye-bye.